For decades, we have held on to a comforting idea of how the stock market works. We picture a system driven by human consensus, where prices move gradually in response to daily news broadcasts and quarterly corporate earnings reports. That version of the market no longer exists. To understand why, we have to look at the limits of human biology. It takes the average human brain roughly 200 milliseconds just to process a visual cue on a screen. Within that exact same 200 millisecond window of time, a single high-frequency trading server can execute over 5,000 distinct trades. We are going to freeze a single chaotic 30-second window of market time. By slowing down the clock, we can dissect the mechanics of how automated algorithms extract wealth from human lack. Understanding this microscopic time frame reveals that the modern financial system is an automated physics equation. The clock starts. T0. A major breaking news headline drops on the global wire. At this exact moment, no human being on Earth has even read the first word. But Wall Street algorithms don't need human eyes. They deploy natural language processing AI to scan, read, and interpret the text in fractions of a single millisecond. To act on that data instantly, institutional funds rely on a practice called co-location. They spend hundreds of millions of dollars to physically bolt their servers directly inside the stock exchange's own data centers. This creates an environment where data is constrained only by the speed of light through a fiber optic cable. Shortening that cable by just a few miles eliminates microsecond delays known as latency. Because of that physical advantage, these servers generate a massive shockwave of automated buy or sell orders within 5 milliseconds of the news breaking. Physical proximity to the exchange is the ultimate leverage. The fastest data wins the trade before the rest of the world even knows an event occurred. Move the timeline forward to the 5 millisecond mark. Let's assume the news was bad, and an unprecedented wave of algorithmic selling hits the exchange. This visualizes the order book, tracking incoming buys and sells. When protective market-making computers detect a tsunami of selling pressure, they protect their capital by initiating a liquidity vacuum. They instantly cancel all their standing buy orders. Look at the consequence on the price line. Without a single buyer listed in the system, the price floor completely vanishes. The stock violently plummets 20 to 30% in freefall. This total algorithmic retreat is the precise mechanical trigger behind the sudden, terrifying flash crashes that occasionally ripple through the market. The drop only lasts until the algorithms calculate the stock has fallen below fair mathematical value. Then, a secondary wave of automated code instantly buys the bottom, violently snapping the price right back to where it started. A sudden stock crash is rarely human panic. It is often automated risk management code temporarily turning itself off and then back on again. We reach the 15-second mark. That dramatic, violent price crash finally reaches a retail investor's smartphone screen through a delayed consumer-grade data feed. The human investor sees the drop, feels a massive surge of panic or a sudden desire to buy the dip, and frantically hits the buy button using a standard market order. But the price on the user screen is already obsolete. While the order travels over public sell networks to the broker, the market experiences slippage, a rapid shift in asset price between the time an order is placed and when it is filled. Because the institutional algorithms have already bought the bottom and driven the price back up, the delayed human order is forced to execute at the absolute highest peak of the microsecond spike. Latency-driven slippage systematically transfers wealth. It forces retail traders to buy at the top and sell at the bottom, directly funding the profit margins of high-frequency hedge funds. The 30 seconds are up. If you zoom out to a daily stock chart, that massive flash crash and violent recovery barely registers as a tiny, unnoticeable blip on the timeline. Attempting to day trade on a mobile phone means bringing human biological reflexes to a multi-billion-dollar laser fight. The infrastructure is specifically designed to exploit human reaction times. The most effective way a retail investor can navigate this environment is to change the time horizon entirely. When you build a portfolio anchored in the structural, fundamental reality of a highly profitable business over a 5 to 10 year period, algorithmic speed and co-location advantages become completely irrelevant. True wealth is generated by playing a long-term economic game that algorithms simply aren't programmed to win.